predictive analytics. How vulnerable a carrier is and how to evaluate how vulnerable they are to competition from predictive analytics, and really what you can do about it in order to protect your own market share from competitors that are coming into the marketplace using predictive analytics. A regional mutual carrier wanted to know how vulnerable their book was to a carrier coming in and using predictive analytics within their marketplace. Their underwriting team had a lot of niche expertise and in-depth knowledge about their particular market, but they were savvy to the notions that advanced data and analytics can create adverse selection. It was a smart move for them to figure out how vulnerable they were or would be if a new competitor entered their market or an existing competitor started to use predictive analytics against them. They had three fundamental questions to answer. How vulnerable was their book to new competitors? How well was their current model working? And did they have enough data in their model? We help carriers with this type of analysis all the time. In order to take real action following this exercise, it needs to be specific to the scenarios an individual carrier faces. It's easy for us to show that most carriers have vulnerability, but what matters is how that would actually play out for you in your marketplace and across your portfolio of business. In this case, the carrier actually had an existing model in place using their own historical portfolio data. And they wanted to know what would happen if a carrier using a model built from more robust industry-wide data started to compete against them in their marketplace. Here's what it looked like in a head-to-head market comparison. Their loss ratio over a 4-year period was about 66.7%. But things changed pretty drastically when a competitor using more robust data for their predictive model entered the marketplace. This carrier's loss ratio jumped to 79.3, and the competitor coming in using that more robust data and predictive model ended up with a portfolio loss ratio of 59.1%. That spread of 20.2 loss ratio points, or what we call the competitive loss ratio differential, is the difference between their loss ratio and the new competitors after market competition. As you can imagine, this didn't sit very well with the carrier. From this analysis, we were able to answer their initial question around quantifying how vulnerable they were to a competitive threat. They were vulnerable to the tune of 12.6 loss ratio points, meaning their loss ratio could rise by roughly 12.6 points if a savvy competitor came in and stole profitable market share from them using a better predictive model with more robust data. And now, they've moved forward using a model that contains more data than they had previously in-house. By leveraging a broader market view, they're sitting pretty with a 2013 loss ratio in about the 50 loss ratio point range.